Home loan interest rates are finally coming down. With the RBI reducing repo rate by 25 basis points for the first time in 5 years, borrowers can expect some much needed relief. But will a rate cut, the first amongst several to come this year according to market watchers, boost loan eligibility and affordability for new borrowers? Hi there, I am Nandita Khemka and you're watching Realty Returns powered by 99acres.com. Now, many believe that this rate cut, which came right after the tax cut announcements in the union budget, will drive demand, especially in the affordable and middle income housing segments. But is affordability truly improving? Or will it take more rate cuts to make a real difference? Should first-time buyers take the plunge now? Or is it wiser to wait? What about existing borrowers? Will their interest burden go down significantly? We break it all down right here on Realty Returns. But first, let's do the math. How much will existing borrowers' home loan EMIs actually reduce with this rate cut? Take a look.
Home loan borrowers can heave a sigh of relief. New Governor Sanjay Malhotra announced a repo rate cut of 25 basis points to 6.25% in the latest RBI policy, paving the way for lower interest rates and reduced EMIs. This marks the end of RBI's longest ever pause, with the first rate cut in almost 5 years. The last time the RBI cut rates was in May 2020, when it reduced the repo rate to 4% to cushion the economy from the impact of COVID-19. Since May 2022, the central bank has raised the repo rate 7 times to 6.5% to combat rising inflation, supply chain disruptions and global price surges. With the rate remaining unchanged since February 2023, this latest cut is a significant development. All retail floating rate loans sanctioned after 1st October 2019 are linked to an external benchmark, most commonly the repo rate. This means home loan borrowers will directly benefit from the rate cut. Since the majority of home loans in India carry floating interest rates, borrowers can expect a reduction in their interest burden and EMIs. Let's understand how the 25 basis point rate cut will impact loan repayments with an example. For a borrower servicing a 50 lakh rupee home loan at an interest rate of 8.5% with a tenure of 25 years, opting for an EMI reduction would lower their monthly EMI from 40,261 rupees to 39,423 rupees. Now, this translates to an overall interest savings of approximately 2.5 lakh rupees. On the other hand, if they choose to keep the EMI unchanged, the loan tenure would shrink by 19 months, reducing the total interest payable by 7.8 lakh rupees. Banks are mandated to pass on the full benefit of the rate cut to existing borrowers at their next reset date. Some banks, including the State Bank of India and Bank of Baroda, have already reduced their rates by 25 basis points, with others expected to follow suit. Following this revision, SBI's interest rates now start at 8.25%.
Well, if you are paying down your home loans, get ready for some relief. I'm sure you're aware that the RBI has cut interest rates for the first time in 5 years. And that means that your EMIs are all set to go down. But the question is, should you consider reducing your EMIs or look at reducing the tenure of your home loan? And with interest rates coming down, will you be eligible for a higher home loan? Should you look at buying property now or wait for rates to come down further? Well, to put all this into perspective, we are now joined by Vipul Patel, founder of MortgageWorld, and Vishal Dhawan, founder and CEO of Plan Ahead Wealth Advisors. Gentlemen, lovely having you right here on Realty Returns. Vipul, let me get in your thoughts first. This may just be the start of the rate cut cycle, and some banks like SBI and Bank of Baroda have already cut rates, while others are also expected to follow suit. SBI's rates now start at 8.25%. How much lower can the rates head from here, especially since, many believe that this is just the start of a rate cut cycle?
Absolutely. I am completely in agreement with you. If we observe, this rate cut has come after almost a gap of 60 or more months. Essentially, rates have been continuously rising and then there was a pause. It was not getting reduced. Taking global cues, this is the first time after 5 years that the rates have reduced. We look at these rates going down in, say, RBI is currently displaying very cautious optimism, and they are trying to balance the inflation as also the various expectations. Personally, I see about 75 to 100 basis points reduction in rate over the past 12 to 15 months. It's going to be slow, but it's going to be gradual. And looking at the overall situation, it's going to be the way that we're seeing it currently.
Hmm. But would you expect another 50 basis points this time around going forward for the rest of the financial year?
I feel they may not go for the whole hog of 50 basis points. What I personally
Hmm.
feel
Hmm.
is they would take it down gradually. So they've done 25. The next round may be about 15 or 35 basis points, followed by another
Hmm.
maybe 20 or 25 basis points. I don't think they will go a single jump of more than 25, 35 basis points. They want a
Hmm.
sustainable run, and they want to build it gradually. That's the way I am looking at it. And they'll also have to keep the inflationary forces under control. Drastic reduction, the real estate sector would heat up, as is there is buoyancy and there is demand that started setting in post the tax cut. So I think it's a good run, and we see the rate of interest slowly and gradually moving down.
Sure. One more question before I move on to Vishal. How much relief or savings would this rate cut result in for existing borrowers, according to you, Vipul?
So when you look at the current rate reduction of a quarter basis point or 0.25, let's say someone borrowed from any bank at say a rate of 8.5%, they would have paid an EMI of 40,261, 40261 for a 50 lakh rupee loan for a 25-year tenure. If the same person had borrowed after the rate reduction, other things remaining the same, the EMI would be down to 39,423, which is overall reduction of about 2.51 lakhs in the overall interest payable. Now, if we were to just change the scenario and say the person says, I will continue to pay the same EMI which I would have paid earlier. So suppose the person says, I'll continue to pay 40,261, they would save roughly about 19 EMIs and an overall interest saving of 7.79 lakhs. So that's substantial considering the fact that just a quarter basis point is having this impact. Now extrapolate it and see how it goes over next 12, 15 months. The consumer is in for a very good surprise, a happy one too.
Of course, a happy surprise, and of course, it was a double bonanza. Of course, if you look at what happened in the budget as well, I'll come to you for that, Vishal. We had tax cuts in the budget, along with that RBI repo rate reduction as well for the first time in 5 years. Of course, we did see how much of interest saving consumers can make. But will this also improve loan eligibility and thus affordability when it comes to buying a house? And of course, is it also going to boost the loan repayment capacity and motivate more potential home buyers to invest in property now, Vishal?
Yeah, so I definitely think that, as this rate cut cycle continues, there will be more enthusiasm because as we can see, the initial 25 basis points cut may not have a very substantial impact, but this will start to show very, very big impacts going forward. I think just to give a sense on how this could work, and we could use a couple or an individual who's got about 24 lakhs of income. Now, at that level, with the new tax savings, considering someone goes to the new tax regime, they would end up saving about 110,000 rupees a year, which is a little over 9,000 rupees a month. And therefore, at 9,000 rupees a month, all of a sudden, your eligibility for a loan on a net of your income basis, because that's how a lot of loans get given out, would probably go up by somewhere in the region of about 15%. So it's a good sort of element to be able to see that these benefits will actually play out to allow you to get a better loan or a higher loan as a couple. I think the important I
Go
think the
ahead.
important thing to keep in mind here though is that there is just a need to be able to figure whether you will actually be able to put away all of that money into savings, because one of the things that has triggered this tax cut has been the fact that inflation has been a little bit of a concern, and families are feeling a little tight in terms of their own expense structure. So what they might want to think about is, just because the eligibility has gone up should not translate into directly taking that money and putting it into a higher EMI.
Sure, point taken. But of course, inflation is showing signs of easing as well. Coming to you again, Vipul, as per the RBI rules, banks have to give borrowers the option to choose between lowering EMIs, reducing tenure, or a combination of both. What would
Yes.
your advice be for borrowers now? Should they reduce their monthly EMI burden or stick to the EMIs and look at reducing the loan tenure itself? What would be more beneficial?
So when you look at the way amortizations work, it's a no-brainer. People should, given the cash flows are working fine and that you are used to paying a certain EMI, if you continue to pay the existing EMI, it always benefits you. So when you are having a loan and you borrowed, you are paying a certain amount, and the rate reduces. Of course, the bank will have to give you two options. One is reduce your EMI or reduce the tenure. By default tenure gets reduced, okay, and the EMI remains the same, and which is the option which the consumer should look at, considering the fact that under the new tax regime and the new salary tax computation, you are having substantial money in hand. So the consumer should also consider increasing the EMI probably, because a small increase, a very small increase, will have an exponential impact on the balance loan tenure and help the consumer to plan their finances better and reduce the overall cost of acquisition of the housing property.
So one should really look at reducing the tenure of the home loan. That's the
Yes,
advice coming in from Vipul. But
retain the EMI.
Vishal, some borrowers, some borrowers, Vishal, are still servicing older loans, linked to MCLR and base rate. Should they switch to repo linked loans now? And what are the administration charges that banks are levying typically for that?
Yeah, so I think it's a great idea to think about shifting to a external benchmark lending rate linked loan rather than continuing to be either on MCLR or base rate. Typically, what ends up happening with MCLR and with base rates is that a lot of this is determined by what the bank does internally. So typically, what could end up happening, for example, is on the MCLR, if a bank has a higher cost of funding, it could actually end up, charging a higher interest rate, which to the consumer or the borrower is not something that gives a great amount of transparency. So we would definitely think shifting to a external benchmark link rate is a great idea. Um, we need to keep in mind that when you make that switch, different banks could charge differently. So there could be banks which are charging like a flat amount of money for that change. Some of them could be, talking about a small percentage, maybe ranging between 0.2 to 0.5% of the outstanding loan. So one would need to contact the specific bank to try to understand. And, it is a good idea to, maybe speak to a couple of banks as well to understand what's the best way that they would be willing to give in. But very, very clearly, our belief is that shifting to a external benchmark lending rate, if you haven't done so already, is very, very critical, because as the rate cycle also plays out in terms of reductions, you would want that impact to show up faster for you, which typically happens with a EBLR rather than through an MCLR or a base rate. Very often, the other MCLR base rate sort of impact show up over a couple of quarters at least, and therefore they're a much slower process.
Sure. Also, likewise, if a borrower is wanting to make a balance transfer and switch lenders, any particular charges that they should be aware of, and what is the gap in the interest rates that would justify that switch? Vishal, if you can continue.
Yeah, so I think people need to be aware of costs. So obviously, the interest rate is a very well documented item, and that's what people look at all the time. But essentially, you want to look at other costs as well. So there could be processing fees which you have to pay. So those can vary from lender to lender. They can go up to sometimes even 1% of the loan amount. Uh, if you're planning to move from a fixed rate loan to um, some other lender, you could even have prepayment charges, but most people today are on floating rate loans, and therefore they don't necessarily need to worry about prepayment charges anymore. There could be administrative fees, there could be stamp duty charges. I mean, all of that put together very often comes to between 0.5% to 1%. But we need to remember that these are all sort of one-time costs. They are not ongoing costs, and therefore you don't need a 0.5% to a 1% differential to sort of make up on the interest cost side. Essentially, what this initial cost does is that for you to break even, it takes anywhere between a year to 2 years. And then after that, you start gaining the benefits of the lower costs, the lower interest rate. So the way to think about it is, try to negotiate as much as you can on all of these costs, but be ready that, there could be an impact which could take place of about 1 year to 2 years. And then after that, it sort of helps you to do better.
Okay, impact of 1 to 2 years, and after that you will, get to feel the benefit as well. Vipul, lower interest rates have historically encouraged fence sitters to take decisive steps, in fact, towards buying property. Is it time for first-time home buyers to make a move now, or would you wait it out for some more rate cuts? You mentioned that next one could be of 35 basis points or thereabouts. Should one wait it out for that to play out?
Now that all of us are in agreement that the rate cut cycle has begun and it is only going to be more frequent. Having said that, it's good to ride the wave. So with a reducing rate cycle, when you ride the wave, you always benefit as you move along. You start with a slightly higher rate keeps reducing, and you keep benefiting, your tenor keeps reducing. So that's one. Uh, Housing essentially in our country is a need-based buy. So I personally don't see any fancitors. It is just that people are waiting because they don't have adequate cash flow. Now, with the change in tax regime and the tax rates and the reduction, it's a double bonanza for the consumer. I think everyone who aspires, howsoever small they can buy today, they should buy, because the real estate pricing is going to increase exponentially, and it may outweigh the benefits of the rate and the tax reduction. So the earlier you buy, the better. Rather than waiting and thinking of the next rate cut, buy whatever you can today, because it will give you exponential returns in any case.
So, will the decision also depend on whether they are buying properties for self-use or investment? Since you made a point that, the real estate prices are, rising exponentially. So, if you have a use case which is either for investment or self-use, should they approach it
So this is
differently?
very good, very pertinent question. When you look at the tax laws, and I'm going to talk about tax now, is earlier when you had a second house, irrespective of its occupation, you were required to pay tax even if it was not leased or rented or not occupied. With the revision in the tax law, the second house, which is not leased, earlier you were paying assessed tax on it, which was a liability, and people were wary of buying a second home. Now, people who can afford will definitely buy the second house, because even if the taxability has gone away, the government has given this one more benefit, and this is purely directed at ensuring that the demand for the housing sector goes up. There are a lot of people who cannot afford to buy a house but want to lease it, and there are a lot of people who can afford to buy but were not buying, because if they can't lease it, here they were paying deemed tax on the rental value. So overall, if you look at the approach of the government and approach of the Finance Act, to me it seems that they have planned it in a way that the demand for real estate will remain robust and stable. People will be able to buy the second home without being burdened by the taxable value of second property, which may or may not be occupied or may not be leased. So I think overall, one should go and buy, even if it's a second home. I think the demand is going to go up in both the directions, the first home and the second home.
All right, point taken. So basically, Vipul is saying go for the kill, don't wait for more rate cuts. But Vishal, what are your thoughts on the same? Because more rate cut would mean more affordable home loans going forward. So according to you, should you wait it out or should you go for the kill now? Vishal?
So I think the way to think about this is, besides just the expectation on how prices of real estate would move and how, loan rates could change, I think there are a few very important items to keep in mind if you're making this decision. Number one in our mind is the job and income stability that you have. I think if there is this uh, sort of uncertainty around your professional sources of income, then definitely trying to take advantage of the fact that prices may go up or loans may come down in terms of rates is not a suggested approach. I think starting point needs to be that do I have financial stability and security that if I'm committing to a long-term loan, I have the ability to pay it back without getting stressed about those monthly commitments that I'm making out. So what if they're at a slightly lower level? Number two is that it's very important to be mindful of what you're buying. And I think right now there is, in an upward moving cycle on real estate, there is a lot of things that come with psychological challenges, including the fear of missing out, a lot of aggressive sales tactics indicating there's no supply available. There are these 50 amenities that are available, etc. So I think people need to be very careful about not getting carried away by just the tax cuts and the EMIs, but take a very thoughtful decision in terms of what they're doing. To add to that, I
Sure.
think the self-use buyer is probably in a much uh, better position to make this decision, because what ends up happening is that a lot of times he or she is going to end up using this property for many, many years. And therefore, the point at entry or the cost of entry, even if it's off by a little bit, may not have a huge impact as long as affordability is clear. But for investors, I think they need to be much more mindful that there are multiple alternatives that they could look at. They could look at, for example, REITs, which are available, which allow you to buy commercial real estate, which could have better yields than what residential real estate has. So I think a lot of investors may have a harder job to make this decision.
Point taken, to contradictory views, though, Vishal is taking a more cautious approach here, but people feels that, the earlier you move, the better for you. But with that, gentlemen, I would like to thank you for taking out time and joining in this afternoon and sharing your thoughts with us. Look forward to more interaction in the future as well. Thank you.
Thank you so
Thank
much.
you.
Well, you heard it from the experts. Borrowers should consider reducing their loan tenure by slightly increasing their EMIs. And for those looking to buy a home, now might be a good time as real estate prices are expected to rise further. Do send in your feedbacks in the comment section below. Well, that's all on Realty Returns this week. See you next time.